Hey everybody, good weekend. Here's your market minute for Sunday, the 9th of July. All right, we'll start with the S&P 500. Here is the monthly, weekly, and the daily chart on the S&P 500 with the associated energy for each time frame. Now, a month ago, we were banging on the table saying, hey, this can't keep going. This can't sustain itself. It has gone into super exhaustion. And guess what? What do we see for the last month? We've seen chop. We've seen the price pull back, slingshot higher, and now what happened on Friday was a small reversal bar with higher highs and a lower close. So based on where the weekly chart is still trying to dig itself out of exhaustion and set itself up. So range expansion leads to range contraction. And so maybe this range contraction is not quite done yet. Otherwise, this is doing exactly what it should do. So while everybody else is predicting doom and gloom and seeing one red candle and saying, hey, the trend is over, no, this is all just part of how markets move. So it just may not be done with the consolidation or the corrective behavior on the weekly chart yet. Now, if we do go lower, where might that show up? Well, we can use fib retracements for this. This is one way that we can identify support and resistance levels where we're likely to see some kind of reaction. If we go out to the weekly chart, we can see that we have a 23.6 retracement, which lines up perfectly with a 4,300. We also have a 38.2 retracement, which lines up with the 4,200. Okay, I don't want to see the price go below 4,200. If it does, that means that something's wrong and it's pulling back deeper than it should in a primary trend. So the most obvious place of support would be 4,300 or just a simple 23.6 retracement, which is not even all that deep. Now, if we go out to the daily chart, and if we look at the latest swing from the daily chart, which really started at the beginning of May, and if we take that from the bottom up to the top, then we can see that the 38.2 retracement lines up perfectly with 4,300. So to me, 4,300 might be the eventual destination for this. I really don't think at this time we're going to see much more downside than 4,300. I think coming down to 4,300 over the next week or two, if it does that, would create a lot more energy in the weekly chart and would basically reset the weekly chart back to ready to trend again. So again, don't make the same mistake as the big Wall Street money managers that all they care about is where they predict the price to be at the end of the year. We don't really care about that. We're looking at this from a month-to-month perspective. And right now what we're looking at is we see a primary uptrend in the weekly chart. However, we're also seeing a trend that needs a little bit of a rest. Coming down to 4,300 would be absolutely appropriate behavior, would reset this chart for the next potential swing to the upside. Now, if that potential swing to the upside doesn't make it, in other words, if we start to see a bounce off of there and it creates a lower high and then undercuts 4,300, then we're seeing a change in polarity at the smaller time frames, and then we've got bigger issues. So maybe something else is happening here, and maybe we are setting up a lower high on the monthly chart. But again, that's not what I'm predicting right now. We're just looking at a 1 month time frame. The weekly chart is still in exhaustion, and we need to see a little bit more corrective behavior before this primary trend can take over again. And if something else is going to happen, we'll know about that if this fails to make a new high based on that. So again, just keep your focus and your perspective from a month-to-month time frame. Forget about where this price is going to be by the end of the year. Leave that to all the pundits on Wall Street that don't make any money anyway. That's it for this weekend's Market Minute. Thanks for listening. We'll see you in the next one.